Hello and welcome to the trade. Before we get to the charts, let's take a quick look at what's going on at a macro level. Oman has reportedly presented Iran with a plan backed by Gulf states to manage the Strait of Hormuz, including collecting voluntary fees for using it. But the US has rejected that idea of tolls or fees, saying that the international waterway should be free of passage. Meanwhile, President Trump has reiterated his threat to bomb Iran's and major bridges if no peace agreement can be reached, saying, I think we have a very strong position right now. If I can avoid doing that, I would like to do that. And the latest US data showing a further deterioration in consumer sentiment, while house prices in May rose 0.2%, slightly beating expectations. US Treasury yields did fall as oil prices continue to ease on hopes for a resolution in the US-Iran conflict. The 2-year down at 4.28%, the 10-year at 4.6%. Now, ahead of the latest read on inflation today, which we've just got, the Australian 3-year was fell to 4.56. The 10-year was just under 5%. So we'll try and check in on that a little later, how that has moved, given the inflation number a little more benign than had been anticipated by the market. The Aussie, it is currently, did take a leg lower off the back of that inflation read, currently at 69.5 US cents. Well, let's get a check on the technicals on markets. Chris Weston joining us from Pepperstone. Chris, welcome back to you.
Good morning.
Well, let's start in the States with a look at.
We can talk about the trim mean number if you want to go.
Well, that'd be terrific if we could, and potentially, you know, what you're seeing there, and obviously we've seen the dollar take a hit here locally. So, how do you interpret those numbers?
Yeah, well, I think let's go back to the RBA. Go back to their statement of monetary policy, which they set back on in May. They had the trim mean number for the June quarter coming in at 3.8%, and so when it came in at 3.6%, so it was just modestly below. If you look at the Q2 numbers, they're just modestly below the street's expectation of 3.7%. It was a slight increase in terms of the rate of change from the prior quarter, but yeah, it was below the street's expectations, and also importantly, it was about 20 basis points below where the RBA had been forecasting there. So that's why we've seen the heat coming out. If you look at interest rate markets at the moment, Aussie dollar swaps are pricing now about a 15% probability, so about 4 basis points of hikes, implied hikes by the August meeting for the 11th of August. So yeah, even that now seems high. I don't think the RBA I think everyone's going to be sort of changing their tune. I think anyone who's been calling for an August hike is now probably going to say that they're going to change their house call and see them keep rates on hold. I think the market's now trying to find a fair value across the rates curve. But yeah, the implied probability of a hike has come down from sort of roughly about 30% at the start of the week to around 15% on the back of this now. And the Aussie dollar dropped about 30 pips or so. And he talked about the 3-year government bond. That's gone from $4.54 down to it's lost about 7 basis points on the back of this. So that front end of the curve is now pricing out rate hikes going out for the next couple 2 or 3 years. So look, good news. I'd imagine the ASX probably had a little bit of relief pop on the back of this. But yeah, I think clearly that trim mean number has caused some reaction in markets, and markets are repricing the idea that the RBA are going to hike in the August meeting. It should be really close towards, well, below 10% by the end of the day, I thought.
Yeah, in fact, the S&P ASX 200 up close to 1.5%, taking a leg higher off the back as the Aussie fell. Do you feel there's going to be more pressure on the Aussie, Chris? I guess maybe the next move obviously is going to come from what we hear from the Fed tonight.
Yeah, exactly. I mean, I think the thing with the Fed meeting now is under Kevin Walsh is he's thrown this conjecture around the idea that they're not going to be so explicit with forward guidance in various upcoming speeches, and that's thrown a large level of conjecture about how you price risk and you price markets and price certainty going into these Fed meetings going forward. But again, yeah, the market has priced about a 35% chance of a hike tonight. Well, I think that's still feels too high. And I think really, I think the Fed funds rate will be kept on hold. I see that as a shoo-in, in my opinion. Although, if they were to hike, it would cause ripples across markets. But I think they'd be able to explain it to the point where the markets would digest that, because it's not out of the realms of possibility that we could get a hike, and we could understand why they would do it. But yeah, I think people would be very surprised, and it would have to be on the conjecture that you guys thought we were going to do it longer term, so why wait? Let's just get ahead of the curve, and I think that would be it. But I don't think they're going to hike. The question is how much do they give us for the rest of the year, given what's been priced in through the swaps curve going forward, and also the level of dissents. I mean, people are expecting Hamac and Laurie Logan to come out and dissent against keeping rates on hold. And, if we were to get 3 Fed officials calling for a dissent, and I think that would be considered to be a bit more hawkish at the margin than what people have been looking for. But I think, as strategists, as market traders as well, we look at where the balance of risk is, around the US dollar, and in this case, the Aussie dollar against the US dollar. And we look at positioning, we look at optionality, skews, gamma levels, we look at expectations being priced into rates markets. And I think right now, it's difficult. I think it's pretty symmetrical. I just don't see, I wouldn't be looking to trade over this. I just think that's a foolish game, to be honest, because it could go either way and the market could key off one thing. But look, the Aussie dollar probably downside. The level you want to watch, of course, is the 200-day moving average down at 69.06. It feels like we get there, but I think, obviously, if the market takes this as a slightly more hawkish hold than expected, the dollar rallies a bit, equity markets go down, and I think it's probably the equity market that the Aussie is going to probably follow most closely there.
Chris, given what we're likely to hear from the Fed, let's go to a chart and take a look at gold first and what you're seeing there and potentially how that may react.
Gold's all over. Gold's just... it's a tough one. We broke above the recent downtrend that you can see from the May levels. We're making these series of lower lows and lower lows and lower highs, and we broke through that trend earlier, last week. But it really couldn't get pumping higher. We wanted to see a material move above 4,200 to see if we can create some FOMO, get that price persistence going, which I personally love. I love trading momentum. I like to go with the flows in the market and align to where that's going to be hopefully going, and try and create, capture some outliers in that distribution. But we just failed just above 4,100. We rolled back down, and now we're just seeing that sideways choppy trade. So the market just doesn't really know what to do. We're in a balance at the moment, and what do we see now? Is the Fed going to raise rates? Are they going to look? Is the next move going to be a cut, or just we're just going to be in this really long extended period of rates being on hold? We just don't know. The market needs to find that information. It's going to be the data that drives what's going to happen on the real rate front. I mean, that's going to be driven more by the crude price. And the crude price itself is up pretty hard, and then it's getting absolutely hammered as well with conflicting headlines playing through, and all the while there's no traffic or logistics getting through the Hormuz at the moment. So I think everything's a bit too complicated for the market. They don't see a clear investment case, long or short. And of course we've got China back in the market buying, Poland, Turkey as well. So we've got central bank buyings keeping a floor in that price just above 4,000. So buying levels, that's when the accumulation zone has been, because people are seeing central banks underpinning that at the moment. But look, we've got a market that's in balance, and that for me, from a high level perspective, just sees strategies that are people looking to buy into pullbacks and looking to sell strength, and until that sort of price persistence come through, I think two-way trading is the way to trade gold at the moment.
Chris, the other key event this week are the big tech results out of the States. Obviously, given what we're seeing with chip stocks in particular, which are under tremendous pressure at the moment, we've got some key numbers coming from Meta and Microsoft. How is this playing out on the NASDAQ at the moment?
Not very well at the moment. And obviously, if you can go and look at the Philly Semi Index or the SMH, which is the semiconductor ETF, they've been getting hit very hard. As everyone's been talking about this massively crowded position, which has been liquidated pretty heavily, and people are rotating into other areas of the market, more value areas of the market, more cyclical areas of the market. And so it hasn't just been a baby out of the bathwater scenario. People have just been rotating out of a very rich and concentrated position. Do we start looking to accumulate positioning? I think I would wait for a bottom to come in. I wouldn't be a hero and try and pick that bottom. What I like to do is rather than buy the dip, I want to buy the rip after the dip. Let the market show they've been making a bottom and hope it continues. But there's a whole multitude of factors. China's come to the party. They've shown that they're a lot closer towards the AI situation and closer to the US than a lot of people have been expecting or have been pricing. We saw that CXMT IPO earlier in the week on Monday, and that just absolutely gone crazy, sort of conjuring up images of the 90s, where it was basically seen as free money to get involved in these IPOs, and I think that's kind of where we are at the moment. The IPO scene in China is really red hot. It's about to really go hard, I think you've got everyone focused on the hyperscalers capex. I mean, Google caused some stirs last week, not just because they lifted their capex numbers for 2026 and said there's going to be a material increase next year, but then said they were running a cash flow negative quarter, and everyone's like, oh, this is going to be thematic of all the hyperscalers, except perhaps Microsoft, who are still going to be cash flow positive next year. But the Oracles this world, they're all going to be running bigger negative cash flow, and that means more issuance in the corporate bond market. Are the credit markets going to be there with the market conditions to absorb that level of credit issuance? That's the conjecture that we're seeing at the moment. So, I think the cash flow issue is one. That capex is going to be on show tonight with Meta and Microsoft, and then obviously you got Amazon tomorrow. So I think that's going to be a big one as well. So that's really the big situation. Are we going to get those returns that justify that massive investment? And we've just seen SK Hynix coming out with reports pre-market, and that stock's down. But they've sort of come out. Go and have a look at their margins, 86%. It's insane. The pricing power these guys have got, and the whole memory space is ridiculous. And that will have to change over time. But for now, they've missed earnings, missed operating income, stock's down, and I think that's not going to do the chip space and certainly in the memory space any favours right now. And I think people are still running these quite short at the moment.
Chris, thanks for joining us on Pepperstone.
Pleasure, thanks, mate.
And that is the trade.